Julian, you have some news from overseas right now concerning REITs. What's going on?
Okay, so we just want to talk a little bit about Realty Income Trust. It is a REIT, real estate investment trust, that holds freestanding commercial property in the United States. So just to quote some key metrics and to give an overview of the company, right? So in terms of its 6 months performance ended June, the net profit after tax was flat, while the core rental income was up 20% year over year. And the expense ratio actually moved by about 2.8 percent. So it moved from 75.73% to 78.5%. But the net profit margin is still comfortably above 20%. So it means that even though operating expenses rose year over year, the margin still remained very healthy. It's a company that generates very strong free cash flow, and that feeds into the dividends. Now, this company is unique in that it is one of the few companies on the S&P 500 that pays dividends monthly and not quarterly. So
Oh,
that's very unique for investors to consider. In terms of the tradability, it doesn't trade very well. So year to date, the stock is actually down 21.2%. Um, and year over year, it's down 20.3%. And over a 5 year period, it's down 18.6%. So there are two ways to look at this. We can look at it as a company that has a strong income opportunity or income generating capacity that is trading cheaply. When we look at the price to book ratio, it means that the company is trading at 1.15 price to book. So it's just trading at a 15% premium of what it's actually worth from an accounting standpoint per share. So we think that the company is cheap with a dividend yield of 6%. As we mentioned, it pays dividends monthly, good cash flow opportunity for investors. The type of properties that it holds is diverse. It includes grocery stores, convenience stores, pharmacies, warehouses, manufacturing facilities, medical offices, and even farms, vineyards, and orchards. The
all over
top
the
three
US?
tenants,
Are
pardon
they
me?
are they concentrated in any particular locality?
No, they're diversified across the US. Um, and as I mentioned, they have agricultural assets, they have industrial assets. So it's essentially real estate assets that are non residential. And the top three tenants are Walgreens, 7-Eleven, and Dollar General. So in terms of sector exposure and in terms of locational diversification, the company is very attractive, but it's primarily for income purposes. And what's interesting is that the S&P rating, that's S&P Global Credit Rating, is A plus. So investors have a chance to participate in a 6% dividend yield that pays monthly on an asset that is investment grade, which is very attractive, considering that you're investing in US dollars. So that's Realty Income Trust. Again, the cap gain is not going to be forthcoming like other stocks, for example, things that are fast movers like a Nike, for argument's sake, or even a Amazon or one of the tech stocks like Facebook. So the idea is to know why we invest. This one is primarily an income opportunity, and yeah, it's worth thinking about.
Good stuff. It's called what called?
Realty
Realty
Income
Income.
Trust.
Realty
Realty
Income
Income
Trust
Trust. Yes,
trades
it's
on the
been around for a
S&P
couple
500.
decades.
Trades on the
And
S&P 500. Realty Income Trust.
Right.
Awesome. What, David?
and just further context, a REIT is a real estate investment trust that's actually defined by legislation. So in Jamaica, we don't have REIT legislation, and the reason why that matters is in the USA, for example, when a REIT sells a property, and let us say that the property, or I should say, capital gains taxes or other taxes associated with the sale, those taxes, are not attracted or impacted towards the REIT. The REIT, just reinvest that capital into new development of property, and they just keep it in a cycle. And by law, they're required to pay out 90% of their earnings to shareholders. So they have protection under the law that gives them some kind of tax shield to an extent, but the somewhat caveat of that tax shield is you have to, pay a good portion of your earnings out to shareholders, which is a very good thing. So in Jamaica, Kingsland Properties Limited, they, kind of built themselves as a REIT, but they don't benefit from like REIT-like legislation like other companies within the USA or other markets that will give them that tax shield when they're selling properties to not be impacted by certain taxes that will be incurred from those sales.
Right.
Just add that context for persons who don't know what a REIT is.
Right. So, Julian, a couple comments here for you. Javon says Realty Income is not a good stock right now. You did kind of indicate that the stock performance, the price performance hasn't been particularly good over the past 5 years, but it's more a dividend play.
Yeah, so for investors who are looking primarily for dividends, as we mentioned, what's unique about the asset is that the dividend, it pays monthly, and it's a company that has a very strong credit rating, A+. So you are getting a 6% dividend yield on an asset that is investment grade. So it's really about risk versus reward and knowing what we're looking for. So it's an attractive cash flow return. It's not necessarily an attractive price return. But the other side of the coin is that as investors, we want to buy things that are cheap. And now it is down 21.16% year to date. So if we reinvest, that means that if the stock falls further, our dividend yield would actually increase from 6% to a higher return. So there are many different ways to spin it, but we're just talking about cash flow returns. We're not talking about something that is going to rally in the next 6 months. And again, we want to take a portfolio approach. We want some of our assets to be cash flowing and some of our assets to be generating attractive price returns, because we can use the cash flows from one section to finance reinvestment in another section. It might not be the best thing to have the entire portfolio doing the same thing. It's good to have a mix,
Right.
generally speaking.
Right. Who am I says, because you mentioned the price to book ratio. He says, I don't like price to book ratio as a financial metric because WeWork's price to book was not bad and they went bankrupt today.
Well, we mentioned the credit rating, and we also mentioned the diversification of the exposures in terms of the sectors. And we also mentioned that the top 3 tenants are our blue chip tenants. The number 1 tenant is Walgreens, followed by 7-Eleven. There's Dollar General, and there are several other established entities like CVS, which is the second largest pharmacy chain in the US. So in terms of the quality of the cash flows, it would be predicated on the quality of the tenants. And these are our blue chip tenants. And given that the company has an A+ rating from S&P Global, it means that the capital base of the company is actually strong. So we're not just talking about P&L and profitability. We're talking about capital. And that means that the company's financial health is very strong. In terms of the net profit after tax, it's generating about 420 million US for the half-year period. So it's on a run rate to generate 840 million for the full year. And the margin, the net pot margin, is above 20%. So in terms of conversion, we're seeing a very efficient conversion of net pot compared to the core revenues. And additionally, in terms of cash flow, the cash flow is actually greater than the net pot. So even though in terms of profit, the dividend is larger than the net profit after tax, it's not greater than the operating cash flows. So dividends are predicated on profits, but they're actually paid from cash. And if the cash being generated is higher than the dividend that's being paid out, then the dividend is sustainable. So we're talking about sustainable dividends, regular dividends, dividends that are attractive relative to the rest of the market. These companies are part of a group called the Dividend Aristocrats. That is a group that is essentially the highest dividend yielding set of stocks on all of the S&P 500. So these are companies that can be tracked. If you want to look at the financial performance, you can see it. If you want to sell it, somebody's likely to buy it from you. So these are assets that you can get in and out of. You can manage your risk. You can lighten up on it if you want to. You can double down on it if you want to. So there's a lot of flexibility for investors, separate and apart from how much cash is being generated.
Awesome. Thanks for
All right.
explaining, Julian.